You're listening to the All-Star Charts podcast with JC Peretz on technicalanalysisradio.com.
All right, everybody, we are back on the podcast with Tony Dwyer. Tony is the Chief Market Strategist at Canaccord Genuity, and you can also get his information at dwyerstrategy.com. Tony, thanks for being here.
Great to be here, JC. Thanks for having me, buddy.
I've been a big fan of yours for a long time. I've been, reading your stuff, seeing your stuff, different videos and whatnot, and I've just always been impressed by, I think the sort of the wide spectrum that that you view the markets through, right? That lens of global, intermarket. You're talking about the stock market, but you're looking at bonds. So you and I see eye to eye a lot on that. So I really wanted to have this conversation. So talk to me. Why don't you give the people a little bit about maybe your background, what you're doing now, and sort of kind of how you got there?
Great, JC, for sure. So I love it when there was a time where I walked into a portfolio manager, one of the biggest portfolio managers in the world in the 1990s, and as I walked into his office, he was looking at a whole bunch of charts. So I said to him, I looked at him and I said, "Oh, I didn't know you were a technician," and he looked at me in horror. And he said, "I'm not a technician. This is earnings." And I go, "No, it's charts of earnings." So what I really do is, I'm kind of known for the practical application of macroeconomic data. And to put that in English, JC, it basically means I use technical analysis and historical reference points on fundamental data. And that includes, intermarket analysis, as you said. I mean, think about it. Who wrote the greatest book of all time on intermarket analysis was John Murphy, a technician. So, that's kind of the backdrop of what I do. And I got into the business in May of 1987. So in a very quick period of time, I saw the best of times and the worst of times and learned how people reacted from an economic standpoint, from a strategy standpoint, from a technical standpoint. It was I learned from a guy named Greg Smith, who is the strategist, Ed Yardeni, who many know now as a strategist. He was an economist back then, and a guy named Joe Feshbach, and then Ralph Akinpour after that. So deeply rooted in the technical and historical framework, JC, and it seems to work out pretty well.
Yeah, I can obviously see it, and you're very confident in it, right? Like, it's very clear that you have spoken to enough asset managers around the world that it is very clear that the things that we're looking at are very, very important. A question that I've always sort of kind of wondered: how does technical analysis of fundamental data look like? Is it are you measuring trends, rate of change? How does that work?
It's both. First of all, you look at trends because, the thing that drives me bananas is that so many people look at and trade off of each individual data point, even though they know how widely revised they are. So if anybody, I'll tell you on this podcast, if anybody trades off of any single economic data point, you got to be out of your mind because you know it's going to be revised. So what you do is you look at the trend of the economic data. And even then, it doesn't really matter that much. But it's like, how, JC, the consensus is normally right up until that final 1% where they act as a perfect contrarian. Human nature is the driver of all. And economic data is the same thing. Think back at this. Remember in the end of 2017 and early 2018, the markets were ripping because everybody was so excited about the synchronized global recovery, right? That was the sale time. That wasn't the buy time. You had an inflection from that peak. And the same thing holds true now where everybody's talking about the slow, they're calling it globalization on CNBC and all the other channels, where I look for those kind of historical human behavior inflection points to get a better gauge of important directional signals in the market.
Well, you've talked about how you've gone back and looked at the microfiche articles, right? So is that what you're referring to?
That's part of it.
So tell me about that.
So it's funny. I in every talk I give, because I'm an old guy now, I always ask the audience, does anybody in here know what microfiche is? And all the old people kind of chuckle and remember how many times they went to the library to look at it, and all the younger people think I'm talking about a biotech company. But it's the microfiche is, for example, if you go back and you look at the Barron's Business Weeks and all the different periodicals, they're not digitally archived prior to 1997. So if you really want to know what was being said in Barron's in the market week in 1995, for example, you actually have to go back and read it on, in the microfiche format and then print it off. And I've done that for the 1960s and the 1990s because, again, the one thing that I've learned, and it's not true, I haven't learned this through talking to other people. I've learned it by making mistakes. I'm really good at making mistakes. I'm also hopefully really good at learning from them. So what I have to do is not remember what I think I remember. I have to go back and see what was actually being said. Like, were people really acting the way I think I remember them acting? And so that's kind of what we did about 1995, and where we came up with an idea literally a year ago that we're heading into a 1995-like environment.
So I was actually going to ask you about that. Can you expand on that? What do you mean exactly?
Sure. So in 1994, core inflation was going down, but Alan Greenspan was very nervous about potential inflation from low unemployment. In other words, the economy was trending toward full employment in 1994. He took interest rates from 3% to 6% very quickly in fear that labor inflation was going to spike and the amount of the debt was too excessive and it was going to cause, an economic catastrophe. So heading into early 1995, he raised rates for the final time on February 1st. Right? And people don't remember that even in March and April of 1995, the Fed was talking about how they needed to raise rates even more, even though the bond market was doing exactly what it's doing today, trending significantly lower. So the market was screaming at the Fed, you got too tight, you don't have as big an inflation problem, and you got to stop. In addition to that time frame, Bill Clinton was being sued by Paula Jones for, indiscretions. He was also being investigated. Janet Reno recommended a special counsel to investigate the Whitewater business dealings. So in an effort to do this, JC, this is where people sort of remember that. They definitely, as I talk to many people, they don't remember this. In an effort to get out of the headlines for the political drama that was in the background, President Clinton started a trade war with the world's second largest global economy being Japan. Japan then, in 1995, was about the same size as China is today. He threatened to put 100% tariffs on the top 13 Japanese cars. And while many don't remember, in the mid-1990s, it was all about Honda and the other Japanese, Toyota. The Japanese cars were huge imports. So as a result of that, capital spending plans in the U.S. tanked. So it was the threat of these incredible tariffs to get out of the headlines, out of nowhere, that caused the kind of first half of 1995 slowdown that we've seen even here in 2019. The Fed then decided between February 1st of 95, which was their last rate hike, they eased just a few months later in July of 95. You even have the same time frame as the first ease this year. And the market had low volatility. It was so similar in behavior to today, it's extraordinary.
And for people who might not be familiar with the chart, I mean, Tony and I have looked at these charts a million times. We could draw them for you at this point. But 95, it was one of the greatest years of all time, and actually continued thereafter throughout the rest of the decade. But 95 specifically was a hell of a year, right?
It was I think since it became a 500 stock index, it was the single biggest year in the history of the S&P 500 from the 1950s, up 34%. So JC, here's the thing. Okay, so people keep asking Jerome Powell, why are you cutting interest rates when the economy's doing okay? They ask Greenspan the same questions, and it comes down to inflation expectations. So in 1995, the market went up 34%. Without more than a 4% correction the entire year. It was similar to 2013, 2017, where you just had this consistent grind higher. It wasn't on a spike. It was just on a slow trend higher. And there were periods where you didn't want to chase it and you waited for a 2, 3, 4% pullback, and then you used that to get back in. But it was almost exactly like the current environment. And it came from the idea that it's not about trying to people today, because the most recent 2 bear markets were 40% plus, keep thinking that if the Fed is cutting rates, you're going to get into an economic or market, it's to prevent or offset an economic or market catastrophe. That's not the case historically, right? Historically, they do it because they're trying to manage inflation expectations, and this is a really big deal right now. This is not about economic catastrophe. It's about Jerome Powell realizing they want to get an average of 2% inflation. How do you do that if it's at 1.6% and you have the same policy, right?
I love the comparison. I think it's fantastic. Let me just play a little devil's advocate. During that period, gold was getting killed, right? In 95, 96, gold had terrible years. But gold's making new 6-year highs. So when you talk about,
buddy, you got to look at that chart again. Pull that up in front of you, JC. 1995. If you look at the chart of gold, it had a massive breakout. There's not a technician on the planet that wouldn't have bought that breakout in 95 until it went down 40%. Correct. So I'm not so sure that this gold breakout won't do the same thing if it is a similar environment. And again, I forgot to mention that when the market was up 20% in July of 95 when the Fed cut rates, it was up an additional 14% in December when they cut rates again, and you had an economic recovery by then, and it was up even more in January of 96 when they did it again. So you had a good economy, awesome market, and the Fed was cutting rates anyway, and they were doing it because inflation was going down, and the bond market was screaming at them to do it, similar to today.
So here's the comparison, right? So you're talking about that failed breakout in gold, and then gold absolutely just collapsed from there. Are you suggesting that we should compare the current breakout to maybe an outcome like that?
I think you could. It's going to depend on currency and other factors, but I'll tell you what, I'm the worst guy to ask on gold because I'm awful at analyzing gold. However, I can't look at it if everything is similar to that human nature behavior event, an economic event in 95, and it's still acting that way, even to the breakout in gold. I'm not going to bet that it's just going to keep going straight up. The optimism in gold is pretty high right now.
So let's talk about that then. 95 was a heck of a year for the US dollar, and it continued making higher highs for the rest of the decade along with stocks. So again, something similar. The dollar just broke out to new highs, right? On the dollar index.
Just keeps going. And here's an interesting thing. You got a temporary reprieve in small caps after the first Fed rate cut in July 95. They outperformed relative to the big cap stocks, and similar to gold, they fell too. So, how many months now and years, frankly, have we been talking about how small caps should do better in a trade conflict because they're more domestic in nature, right? And yet here we are. The small caps have had massive underperformance. And that is some chart to look at, because while people want to buy small caps, the relative performance, again, it did bounce after the first Fed rate cut, but that failed, and you didn't make a low in relative performance of small to large until 1999. You were up 20% a year in the market, in the S&P, over 20% a year for those 4 years, and small caps underperformed, even though you were in the Asian economic crisis and they were more domestic in nature. So It's just kind of a heads up to be careful. And JC, what I do on DwyerStrategy.com is I do some myth busters, right? I take some of these market thoughts and that become conventional wisdom, and I actually check to see if the data supports it. So here's an example for one. You know how, but so if I'm right next year and the S&P 500 goes to 3350, that's my target for 2020. It's based on 176 in earnings for S&P operating earnings and a 19 multiple. So I'm looking at 9. If I'm right, that means the current consensus estimate for earnings is $9 too high. And I'm looking for a multiple expansion. And people look at me like I got 10 heads. Like, how do you think the multiple's going to go up when earnings revisions are going to be negative in the out year, if you're right? Right? That makes sense, right? Well, guess what? The only 2 years this cycle you've had upward revisions in the out year were 2011 and 2018. The 2 years you had a multiple compression and negative returns for the market. So just be careful on what seems like conventional wisdom, like small caps should act better because they're domestic in nature in a weak global economy.
Yeah, I mean, we've gone back and talked about different periods where stocks in general, particularly large caps, are doing great and small caps are just underperforming. You know, Russell 2000, flat over the last 12 months, mid caps down, micro caps down a bunch, micro caps down like 13% or something like that over the last 12 months. So it we don't necessarily need outperformance from the small caps, but I would argue that it would be evidence of some sort of risk appetite out there if small caps do start to at least perform on an absolute basis, particularly because of their exposure in regional bank stocks, right? That's really where the angle that I'm looking at it.
Well, I got to say, you mentioned bank stocks. This may be one of the worst calls in my career was to be long banks, right? They haven't worked at all, or the financials. And I think my buddy, Josh Brown on TV the other day did a great job of saying there's differentiation within the financials that you have to address. The banks may not be doing great, but there are periods where they will do great. And we're probably entering one of those more offensive periods, as the Fed is cutting rates in a non-recession environment.
One thing I find really interesting, I'm glad we're talking about the financials, is sort of this new revolution. I mean, it's not that new at this point. We've been watching it for years, but the sort of the fintech side of financials, when you look at indexes like iPay, which are like the mobile payments, or the GFIN, that Goldman Sachs financials X banks sort of fund, when you look at those indexes, how well they're doing, but they're basically technology stocks that are being called financials, right? That's why they're doing so well.
Well, kind of. I mean, it's the Rocket Mortgage. It's shadow banking. So and the fintech is basically, there's two kinds of banking, JC, that are in the marketplace. Yeah. Okay. Let's take it from this angle. You know how the entire globe is growing, but the majority of the growth is coming from China. That's kind of been the pro-China story for the entire cycle, right? You agree with that? Most people would agree with that, right?
I don't particularly opine on that sort of stuff. I'll leave it to you. I'll defer to you.
So like if the world is growing X%, a big portion of that growth rate is coming from China, right? That's factually accurate. The whole thing is shadow banking is the same thing. All lending has gone up, but the majority of the growth has come from shadow banking. Now, shadow banking is just simply non-traditional bank lending. So it's, Rocket Mortgage, it's the Navy Credit Union, it's some of the online things like On Deck Capital, things like that. That's where the money, that's not under the purview of the Fed. So banks have been regulated and restricted from Basel III and other regulatory environments, and their lending standards are much more strict than non-traditional banks that don't have a Fed. They're not overseen by the Fed. They can do whatever they want. So the growth in non-traditional bank lending and private equity and private credit has been so extraordinary, yet the Fed doesn't see it, so it doesn't fall into their purview, and they don't really have any comments on it. So I think when we think about the financials and fintech, just remember that the majority of growth is coming from non-traditional lending and non-traditional sources, which is a dislocator, and that's why they've done so well.
you could see it. I mean, just the relative strength compared to, when you look at, Goldman Sachs or,
Yeah.
Wells Fargo looks terrible. I mean, in comparison to all of these things. But what on that note, I'm a big fan of monthly charts. I look forward to my monthly candlesticks every 30th or 31st. I only look at it once a month, so 12 times a year. It takes me half an hour. Best 6 hours I spend of the year, hands down. And one of the charts that I try to include a handful of bellwethers, JP Morgan in particularly being one of those, especially with the correlation it's had with the S&P going back, since the beginning. I mean, when you look at a chart like that, Tony, would you agree it's a bellwether of financials and the overall market? Are you on the same page with
Oh
me?
yeah. Yep.
So,
Yep.
I mean, when you look at that chart, I mean, I just don't see, when I ask myself, all right, is this a healthy consolidation over the last 18 months within an ongoing uptrend? Or is this a massive distribution with impending doom, right? Is the question that I'm posing. And to me, it looks good, looks healthy. I mean, I think that's positive for the
Yeah.
market.
Well, let's look at 2015-16. So, of all the people that are tuned in, can pull up a weekly chart, let's say, or monthly chart, whichever one you want to pull up, and you look at the period from 2015 to the low in 2016. If you're a pure technician looking at price, there's no question that you were a seller on the trend break in late 2015 and early 2016. Like that, you broke trend, you did everything wrong. And then that was the low print before an extraordinary move into the 2017 peak, right? So I think, until the Fed inverts the 210 curve, until credit shuts down, which if you want, JC, we can talk about how do you identify that.
Yeah.
Until that happens, I'm in your camp. I think once you break this out above maybe, then you got a shot. And again, I can't comment on individual stocks, so in no way am I going to recommend an individual stock. But on a chart, yeah, you look for breakouts in the context of intermediate to long-term uptrends.
So let's talk about credit. One of the things that I appreciate about the work that I've seen you do, is you're focused on the credit markets when we're having a conversation about the stock market, right? So that's right up my alley. We're on the same page there, exactly. So explain to me how you approach credit, which spreads you're looking at, and are you focused on those markets at all times or when volatility is elevated?
At all times, because without question, credit is the driver. So here's where a rational person would say, well, the 10-year Treasury yield is at 1.95%, right? And the lower bound of the new Fed funds rate from yesterday is 2%. How can you possibly have the 10-year piece of paper yielding the same as an overnight rate? That makes no sense. So the statement people say, JC, is, well, the bond market is telling you something. And then I would challenge that statement. That's too simple. That's a made for TV or made for Twitter statement. You got to identify which bond market you're talking about. If you're talking about the Treasury markets, the only time it's really quote unquote telling you something about the economy is when it's associated with degradation in the other areas of credit, the private credit market. So how do you measure that? High yield debt to Treasury spreads.
Yep.
Right?
Yep.
And when you're about to go into recession, the yield on speculative grade paper is spiking in a risk off trade. So if you pull up the Barclays high yield total return index, it's making a new high almost every day. That is not what happens heading into a recession. So how do you have the highest risk area of credit doing terrifically as the bond market yields are tanking below the lower bound of the new Fed funds? And the answer is very simple. The market is screaming at the Fed that you have no inflation, make it stop, don't become Japan and Europe, while saying that the economy is okay, so you can actually adjust like 25 here, 25 in September, and maybe 25 basis points more in December. So the bond markets are telling you two different stories. The treasuries are telling you there's no inflation, but the corporate credit and stress indicators are telling you that you're still okay economically. So that's why we look at this first Fed rate cut in the context of a non-recession environment because corporate credit's doing just fine.
It's funny how we're not talking about the yield curve every day. You notice that, Tony?
I talk about it every day. No, people are just sick of me talking about it. Well, okay, let's do it again. 3-month and 10-year or the 2-year and 10-year.
Right. So when you look at the longer end versus some of the more Fed manipulated part of the curve, they're doing different things, right? So you want to touch on that?
Yeah. So the Fed can drive. The Fed only controls bank lending. Right. So in theory, the reason they use the very shortest, the 3-month versus the 10-year, is you get your money at the deposit rate that you got to pay interest out on, savings account, checking account, money market, whatever, and then you lend it out in a longer duration. So that's why the Fed looks at the 3-month and 10-year. But that's not how shadow bankers, which is the biggest growth in lending over the last 3 cycles, that's not what drives their lending. It's the 2-10 curve. So the 3-month, 10-year curve is telling you that you're certainly going to see a slowdown in bank lending. It's why inflation expectations keep coming down. But the still positive 2-10 curve is saying that there's still credit availability in the non-traditional bank lending or shadow banking. I look back because I want to make sure that I'm not full of BS. And I go on TV all the time and talk about the 2-10 curve, and people say, "Is that what you always talked about?" I went back and I looked at in the first week of 2006. I wrote a report, and it's called, again, like you'll find on DwyerStrategy.com. It was Yield Curve Mythbusters, and I evaluated the 2-10 curve. So as long as shadow banking is driving a significant portion of the money availability in the U.S. economy, it's actually the global economy, you want to use the 2-10 curve because that's what drives their lending.
So in 2006, at the end, the yield curve did invert, right? And that was what, about 8 months? No, sorry, 10, almost a year.
It was earlier in 2006. Yeah, and so the data, the historical data of the 2-10 curve is if the 2-10 curve inverts in the next 15 minutes, which if Jay Powell is forced into another press conference might happen, he did so well at this one, that if you actually invert the 2-10 curve in the next 15 minutes, historically you get an increase of 21% to peak. Over the last 7 cycles, you get a gain in the S&P to 21% over 18.5 months, with a recession not 19 months away. If you do it in the last 3 cycles, when they're more similar to now, where you have a levered economy, too much debt, all that fun stuff, it's a 34% gain over 22 months, with a recession not happening for 25 months. So we think it'd be closer to that. So the worst case scenario can help cause a correction, but the peak of the cycle comes well after an initial inversion of the curve.
And that's one of those things, Tony, that you talk about, like the myth busting. People talk about, oh my God, the yield curve is falling. Oh my God, it was about to. But then historically, the stock market does very well in an environment
it's a buy signal. It's a buy signal, right? And think about that. I mean, all too often what we do are these great academic PhD kind of silly studies instead of just using common sense. Historically, the yield curve inverts because short rates are going up and long rates come down. If long rates are coming down, what does that do to interest expense? It takes a little while to shut down bank lending. What it does to interest expense is it brings it down big. Right, you get a reduction in mortgage rates. Like even now, think about this, JC. In the last 6 months, we've come down over 100 basis points in the 30-year fixed mortgage rate. That makes a lot more houses affordable, and activity picks up. So you have to be careful when you take, again, these conventional wisdom things. I know you got it on allstarcharts.com, and I certainly have the Mythbusters on DwyerStrategy.com. Just make sure, and if you don't want to go to either one of those and you're listening to this podcast, don't listen to people like us without doing your own work. Go and look at the charts, look at the data, feel comfortable with your decision. It's the only way you can stay with it when it goes against you.
There's absolutely no question. We're talking about. You mentioned the S&P 500. And you have a target near mine. I hate like targets, but based on measured moves of certain symmetrical sort of behavior of the market, I think 3,300 is perfectly reasonable. You thinking 3,350, so we're on the same page there. But when you're talking about rates doing what they're doing and metals doing what they're doing, what about on a sector by sector sort of level? What does the macro picture and the inner market environment suggest about which sectors we should be maybe focused more on through the end of the year?
Well, when you get the initial rate cut, what traditionally happens, and we have a chart of this where that's provided by our friends at Ned Davis. They do a terrific job. Anyway, the chart basically shows the sector performance in a not after the initial Fed rate cut in a non-recession environment. What happens is you get a dip right away, kind of like you did yesterday, frankly. You get like a 2% to 3% dip right away, and then you have a gain of average 24% over the course of the next year, driven by offense. But it's not heavy cyclical offense, meaning materials, energy. It's offense like communication services, technology, financials, that kind of offense, consumer discretionary, industrials, instead of just the deep cyclicals.
And then when you do that sort of top-down analysis, right? Correct me if I'm wrong, but you're starting with the global macro, you're starting with the intermarket picture, and then working your way down to the sector level. Is that the process?
That's the process. So, again, the whole point of technical analysis is human behavior, right? And how it repeats. What creates supply? Well, you get back to a price where you had more sellers before and they want to get out break even. Right? What creates support? Well, you bought something at a level, it gets above that and comes back to it, it's good, so you want to buy more. Human nature is what drives technical analysis. So you really have to, I really have to make sure that my framework is right and that I remember that every period to some degree is unique, but human nature is the only thing I can find that's consistent. So I start out with, okay, where are we on the macro trends? What's the behavior of consumer and businesses and what drives that behavior? And it always comes down to credit. So the underlying assumption that I think you have to make in any investment decision is how close you are to a recession. And that's what drives performance in both the market and sectors. And that is driven by the availability of credit, which we talked about a little bit earlier.
So we focused on on the U.S. markets for the most part. Looking more globally, what do you think about just this massive just underperformance out of international equities for so long? Like, where does that fit in history when you compare prior periods?
Well, it's similar to the 1990s where you had this deterioration after the Fed started raising, Greenspan started raising rates in 1994. It kind of kicked off a negative feedback loop in the emerging economies and international markets that didn't stop until after you were in crisis mode by the end of the bull market in near 2000. So it was really a domestic U.S. driven economy, and I don't see any reason why that's not going to be true today. The issue so this is a really big point, JC, that it's kind of an important thing that we've recently come up with. It's a generational shift in how the Fed views inflation. And outside of this the press conference before, and then the testimony to Congress on Capitol Hill a few weeks ago, Powell and then his lieutenants all talked about not wanting to be Japan and now Europe, right? And the problem is you're in this situation internationally where no matter what they do, they have slow growth. You have negative rates in Europe and they're buying corporate debt, yet you have horrible growth, 7-year low in German data, right? And then Japan has been in a 2-decade-long kind of plus or minus recession period, based on deflation fear with zero interest rate policy. So the Fed has got to be scared to death of going into that negative feedback loop and down that rabbit hole. So I think they're going to be pretty aggressive here on the near term, a lot more than the market currently thinks, especially in terms of what their monetary policy is going to look like.
What about that chart that's going around that's showing the percent of countries around the world with negative interest rates, and it just keeps making new highs?
Yeah, and I can't imagine because you have slower growth that's going to change dramatically, right? So I don't know what the implication of the chart is other than to say maybe you get temporary respites out of the international markets relative to the U.S. markets. But at this point, I think you still have interest rates at a level in the U.S. and coming down quickly enough that you could have at least some kind of growth, whereas in those other economies, it's pretty tough for them to find any growth.
Tony, I love the conversation that we're having. I think that we can do this all day. Before I let you run, we could just keep going. I could just keep firing back and forth, and you can fire them back towards me. I don't care. But one of the things that I was interested in, right? Because how the private markets, because we were touching on that before on the lending side, but just private markets in general, and the availability of cash without having to go public, and a lot of these companies being able to grow and do the things that they want to do without having to go public. And in the old days, correct me if I'm wrong, companies would go public to raise money to be able to grow their companies. Now they're going
Correct.
public so that their founders and investors can get liquid, right? Can you touch on how maybe that's changed the market at all, or if it hasn't, or maybe something that as investors maybe we should be aware of that perhaps some of us are not?
Well, there's a private equity. The boom in private equity is where is happening because all the pension funds go there, and you don't have to mark to market. So there's a significant amount of money being raised in private equity, and I think that's probably, JC, what we're talking about here, right?
Yeah.
Right. Okay. And if there's ever a place where I could identify significant excesses that are inappropriate, it's likely in the private equity market, and that's fine until it goes sideways. So let's say it's a bubble. When you're blowing up, I know you got, many of the listeners are going to have children. When you're blowing up a balloon, right, and it's in front of your face, or if you're blowing a bubble with bubble gum, as you're blowing into it, you're thinking it's getting big and it's about to explode, right? Until you put another 10 breaths in it. It takes a lot longer than you think. So this boom in private equity and private lending continues to build, and it continues to build, and it becomes excessive, and people can't believe how excessive. And then when it stops, that's when you're in trouble. And if you think back into the 1990s, what most people again don't realize is Netscape came public in 1995. And it doubled the pricing for the IPO doubled the day of the pricing, and then it opened up like 2 to 3-fold, right? So that was considered a bubble in the technology market, and it didn't actually pop until 2000. So trying to time when these things go sideways is impossible. But just understand, there is excesses in the private credit market and private equity market that will not end well. And JC, we know this, right? You cannot fix debt with exponentially more debt. This thing's going to go sideways. At some point, this is going sideways. There's no data and credit to suggest that time is now.
But what I sort of struggle with, I suppose, or what I think about anyway, is what do we have to compare it to? Like what's to say that the money in the private markets is excessive, and it's not a new market and just a new place to allocate assets like an S&P 500. There are real companies there, and they're doing real things, and there's real value and there's real wealth. Perhaps maybe in the credit markets and
there definitely is. There definitely is, and it's giving entrepreneurs extraordinary opportunities. So it's making the economy, it's helping the economy work. So I'm not saying it's a bad thing, but anything, even if it's a good thing to excess, becomes a bad thing. Now, how do you know when that happens? To answer your question directly, Well, it starts to show up in all the other credit stress indicators. Yeah. Right. If private equity and private lending is starting to see high delinquency rates, you got to know that the public stuff is too, right? But delinquency rates aren't picking up in household or corporate. If we all know that bear markets in the economy in the U.S. is driven by credit, there's nobody that I've met that doesn't think that's true. How do you have a credit crisis if you don't have any credit stress? And how do you have credit stress if you don't have credit delinquencies yet?
Yeah, it'll definitely trickle over, and we'll see it. So, I mean, it'll be traditional analysis that we've done throughout history. Correct. You'll see the credit spreads blowing out, and we'll know something's wrong, right?
The line that I talked to a lot of portfolio managers over my career, and the line that we all love to quote in the media is, "It's different this time," right? People say, "Oh, that's such a terrible." That line, there's a line that has killed more portfolio managers than that line, and the line is, "This will end badly," because it's always right.
Yeah.
But it happens so soon that if you're saying that, people have been saying that this will end badly for the last 5 years. Forget about whether it's right or wrong. Look for signs that it's not working. Who cares if it's right or wrong? It's like the Fed. It's like, who cares if the Fed is right or wrong in what they're doing? They're telling you what they're doing. They're pumping money into the game.
Tony, I've been wrong in stocks for 8 years because the Fed doesn't know what they're doing.
Right, exactly. Exactly. And I know through all the mistakes I've made in my career that I'm an idiot. Right? I just need to follow what the data says. As soon as my opinion gets involved, we got problems. That's why I stick to the data. Practical application of macroeconomic data, which means technical analysis of fundamental data.
I have so much respect for that, Tony. Everybody, Tony Dwyer, Chief Market Strategist at Canaccord Genuity, and you can get his information at dwyerstrategy.com. Tony, thanks for being here, man.
It's a pleasure. Thanks for having me, JC. Have a great day, buddy.
You too.
Thank you for listening to the All-Star Charts podcast with JC Peretz on Technical Analysis Radio. To see all of the charts mentioned on today's show, please visit allstarcharts.com/podcast.